Thanks for staying with us. We'll begin this segment with the stock market wrap-up. And of course, we know that the unveiling of the guidelines and framework of the new flexible exchange rate policy by the central bank pushed the key broad index to a 158-day high of 29,274.27 after increasing by 7.40%. The market capitalization climbed to 10.04 trillion naira. Total volume traded surged to 2.15 billion shares, worth 20.39 billion naira, and traded in 24,369 deals. Market breadth turned positive with 44 gainers, led by Champion Breweries with 27.31% against 23 losers, led by GlaxoSmithKline with 21.91%. Banking stocks dominated market activity as UBA maintained the lead by volume, pulling 572.77 million shares. The Apex Bank, of course, finally released the much-awaited flexible foreign exchange policy guidelines, surpassing expectations. As we saw earlier, the new policy, which includes the adoption of a single FX market structure via the interbank market, rallied the equities market, and of course brought back activities to the debts markets. The head of research at Vetiva Capital, Pabina Yinkere, joins us now to talk us through how these changed the bearing of the markets, the OTCs, the FMDQ OTC, talking about the bonds instruments, and of course the equities instruments. Welcome, Pabina Yinkere, to Capital Markets. Let's take a look at your own perspective of how this FX policy of the CBN changed things at the equities markets during the week.
Thanks for having me, Temple. The news was very welcome news in the economy as a whole and even in the financial markets. The markets was expecting to see that there was some devaluation of the currency and a little bit of flexibility. But I think the whole framework that was released was, I would say, beat market expectations because people weren't expecting it to be that extensive. Many of us were not calling for a free float of the naira. We just thought maybe there would be some devaluation, put some cap around where the currency would trade. But I think what was announced by the central bank governor was quite impressive. We think it'll go a long way to really shape the way things move from this country here on, given the situation that we're in at the moment.
Okay, so giving our attention to stocks, we know that a lot of banks are listed in the stock market, yes. And some analysts have come out to say that, look, this is going to create or increase the rate of non-performing loans that we have in the banking sector. How correct is this?
I would like to view that in two ways. One, I would like to look at it in terms of, if you look at non-performing loans as a Q1, numbers released by the central bank is around 10%. NPLs in the banking sector, that is rather high. The central bank prescribes a limit of around 5% for banks, but we're having 10% today. This is reflective of the overall challenging economic environment. And part of the things that have led to this tight economic environment is the tight exchange rate policy that Nigeria has adopted for the last year or so, or maybe for the last 16 months. Yeah. So if you look at it, for me, when I look at it, I see that we are going into a regime where it is possible that the constraints with the FX will be lifted. You would have a lot more liquidity. So from an economic perspective, I think that is good. It should help those manufacturers that have been crying for the lack of FX to continue their business can now have an opportunity to source FX and carry on with business, albeit at possibly a higher rate. But I think overall it's good. The other angle I'll look at it from, where I think it could lead to some NPLs, are companies and firms that have dollar liabilities and have naira revenues. Those are the kind of companies that will really be hurt at this very moment, because what it means is that your liability is increasing and your naira correspondent is not adjusting appropriately. If you want to take an example of that, I can look at the power sector, for example. Yeah. Many of the companies that bought over the PHCN assets had borrowed in dollars, and of course we know their revenues are in naira, so there is a currency mismatch there. However, I would also state that embedded in the MITO pricing model for the electricity tariffs is a component to adjust for exchange rates. However, you don't want a situation where you adjust for exchange rate and passing through an increase in tariff might become very challenging. If you recall, we just had a tariff increase in January, effective February. Yeah. So with what is happening now in June, you would expect, I mean, in a normal situation, you would expect that these companies would also reflect this new exchange rate in their models. If it comes out higher, reflect this new exchange rate in their models and then price higher. But of course, you know how things are. It's not going to be easy to push through a tariff increase. So this company may have to take some pain for a while. So in that angle, it could have a problem. So I wouldn't overall just say that because companies the economy may be operating in a higher, at a much depreciated or weaker naira level, that it will automatically lead to bad loans as such.
Will it increase the risks on large portfolio of dollar-denominated assets?
Dollar-denominated assets, if anything, is a plus for dollar-denominated assets because what it means is more naira on conversion, So for dollar-denominated assets, it's a plus. The challenge is with dollar liabilities because your costs just shoot up from there.
Okay, so let's also look at how it will impact on inflation. Currently, our inflation rate is around 16%, 15.6% from 13.7%.
Yes.
What do you see this new FX policy changing, given the fact that it is going to also amount of futures, some other derivatives specifically will be introduced at the markets?
In terms of inflation, I don't think we're going to see inflation run away from the current levels, and I'll explain why. If you look at the economy over the last 16 months, I mentioned earlier that things have been pretty tight. Yeah. Part of the feed through to inflation, the main things driving inflation are higher fuel prices, higher electricity prices, high food prices. Embedded in food prices are possibly some angle of the higher fuel, which is feeding into things like transportation and all of that. So with the liberalization of the downstream market, you would expect that the fuel market would ease up a little bit. Right. That is on one hand. And then if this FX policy does work, for now everything is still on paper, but if it does work, I think it will be positive for the tight environment in terms of manufacturing and all of that, like I explained before. Yeah. So what you should see is an easing of things. Would it lead to higher inflation? Possibly, yes, because we might end up, we don't know what the rate will be. On Monday, we will decide that, but we might end up with a rate that is higher than the 199 we see today. But when you look at it, many companies have not been operating at that level. Right. Many corporates, even large companies that produce your everyday staples, some of them access FX via the black market. So companies are reflecting a much depreciated naira rate in their products. So by the time you see this exchange rate come through and companies have free access to that exchange rate, the rate might actually be lower than you see at the black market. So overall, it might not necessarily lead to a step change in inflation, but I would expect it to have some bit of impact in the inflation figures.
Obinna, let's have you hold on to your thoughts there. We'll quickly take a look at some of the African markets that we track. During the week, Dar es Salaam Stock Exchange made an impassioned appeal to the Tanzanian government to reconsider the proposal to introduce capital gains tax on shares. And of course, the chief executive of that boss, Mr. Marwa, made this appeal given the fact that, look, things are not going to be going well with, of course, a lot of the stocks. It's going to scare away investors and all of that. But quickly, we know that this had an impact on the numbers from that market. We saw the Dar es Salaam Stock Exchange closing at 10,166.60. Yesterday, it ended 0.02% uptick. The year-to-date was 5.20%. Now, the BRVM index had a close of 309.82. or having closed 0.60% downward. The year-to-date of that market is 1.94%. EGX30, which is the Egyptian Stock Exchange, also ended 0.08% uptick, having been driven by some other news that came into that bourse, and the year-to-date of the market is looking green at 5.91%. The Johannesburg Stock Exchange closed 0.22% higher yesterday. It gave the year-to-date performance of 0.66% when the all share index closed uptick at 52,140.61. After the break, Pabina Yinkere, who's still with us, will be giving us a sense of how other instruments reacted to the new FX policy and what the outlook is. Don't go away, we'll be right back shortly after this break. Thank you for staying with us. Let's run you through some of the activities at the OTCs this week. The USI closed at 634.13 points against 633.94 points seen in the previous week. The market capitalization also inched up to 419.76 billion naira against 417.63. Volume traded increased by 22%, while the total value of shares traded decreased by 89%. The market had 63 deals this week, and IGI and Friesland Wamco continue to take the lead in trades. At the bonds market, primary market auction on Wednesday was oversubscribed by 63%. The Debt Management Office auctioned 15 billion naira of the February 2020 bonds, 40 billion naira of January 2026, and 50 billion naira of March 2036 bonds at the FMDQ OTC. We saw that the July 2016 T-bills had 72 deals, and that's translated to 17.85 million naira. April 2017, as well as November 2016, was some of the other securities that had a boost from investors. The bonds market had March 2036 with 72 deals, July 2024, and March 2024. A total of 147 deals was recorded on that market yesterday before the market ended. Now, the head of research at Vetiver Capital is still here with us. And of course, before we end the show, we'll quickly get his perspective as to how this new FX policy impacted FMDQ bonds market, as well as the T-bills, and of course NASD OTC, because I know that your company also trades very well on the NASD OTC.
Okay, I'll start with the bond market. The news was positive when it came out in terms of bond. However, the CBN had to do some liquidity mop-up close to the end of the week. They issued the OMO auctions, and then there was a bond auction as well. So those two events sort of like sucked out liquidity from the market, so it led to a little hike in rates. So across the week, there is a little hike in rate. And going forward, what I think would happen is the CBN would need to keep liquidity tight within the banking system to support this new exchange rate framework.
And how can they really do that?
Now, what's going to happen, what you will likely see coming into next week is that we'll probably have a bit more OMO auctions to mop up liquidity. And the rationale for doing this is you have announced a flexible exchange rate regime, which is going to be determined, price is going to be determined by the interplay of demand and supply. Now, if you look at it, the demand is going to be coming from many of the people that have been sitting on the sidelines wanting FX. So a good way to keep price in a moderate level so that it doesn't run away is to contain demand whilst you try and supply as much as you can. And a way to contain demand is to mop up as much naira as you can in the banking system so that people do not have enough naira to go and bid for the dollars. So that way you can keep the rate at a very, should I say, a very comfortable level that the CBN might want. So you would expect that liquidity will be very tight in the system. And once liquidity is tight, interest rates are going to go up because there is not enough cash within the system. So I would expect that rates would begin to tick up going into the coming weeks.
Okay, Pabina, in 30 seconds, quickly tell us what you think can go wrong, like as a challenge that can balk this whole plans that has been put in place.
Execution. And I will say execution because we've seen a very, very good document released by the central bank. It seems like it was well thought through. But then when the market resumes on Monday, how the operations happen is going to determine how well the market receives this new FX framework. So I think the execution is very important, starting on Monday.
Thank you so much, Pabina Yinkere, Head
Thank
of
you.
Research at Vetiver Capital, for coming on Capital Markets this evening. And on that note, we'll draw the curtain on the program. I remain Temple Ashaju, your host, and I'll see you next time.